All right, today we're diving into an analysis of Shree Pushkar Chemicals and Fertilizers. Now, this is a company at a really interesting crossroads. The big question this research poses is pretty straightforward. Can a traditional, kind of cyclical chemical company actually turn itself into a steady, long-term wealth creator? Let's dig into the case.
So the main argument here is that Shree Pushkar, or SPCF as we'll call it, is right at a major turning point. The thinking is it's shifting from being a classic cyclical business, one that ebbs and flows with the economy, to becoming a long-term compounder that can deliver steady growth. The really heavy spending phase, the big Capex cycle, is behind them. So now the focus is all on cashing in on those investments.
So what's their secret sauce? What gives this company its edge? Well, the entire analysis really hangs on this one key idea, a unique competitive advantage that the source calls a zero-waste moat. At the very heart of SPCF's strategy is this idea of a circular economy.
And look, this isn't just some fancy buzzword they put in their annual report. It's the actual engine that drives their profitability and makes them resilient in an industry where, let's be honest, waste is usually just a huge cost.
So how does this actually work? For most chemical companies, their wastewater or effluent is just waste. It's a problem they have to pay to get rid of. But for SPCF, it's a completely different story. The waste from making dyes actually becomes the key ingredient for their fertilizer business. It's brilliant, really. This integration creates a natural shield against volatile raw material prices and lets them squeeze profit out of every single step of the chain.
Okay, so that's the core idea. Let's build on that and look at the bull case, all the arguments for why this integrated model could really fuel some serious growth.
A huge piece of the puzzle here is something called Unit 5. This was their biggest recent investment, a massive capital project. The critical thing to understand is that this new unit helps them move away from basic, commoditized products and into higher value, higher margin stuff like reactive dyes.
And the impact of this shift is expected to be pretty significant. The analysis is actually projecting a 20% compound annual growth rate just in the dye segment. Now, what's driving this? It's really three things. First, getting Unit 5 fully up and running. Second, growing textile demand right here in India. And third, this global push for buyers to work with ESG-compliant companies, which SPCF is.
Another really strong point for the bulls is the company's big move into sustainable chemistry. They're now getting almost 60% of their energy from solar power. You know what that means? It means they've built in a permanent cost advantage of about 3 to 4 percentage points. In finance terms, that's 300 to 400 basis points. It's a fantastic hedge against rising power costs.
This whole integrated model also gives them a defense against a major industry headache, global dumping, especially from China. While a lot of their standalone competitors are getting squeezed with margins down around 5%, SPCF can just use its own intermediate chemicals internally. This allows them to keep their volumes up and hit much, much healthier margins. We're talking in the neighborhood of 20%.
And then you have the other side of the business, the fertilizer division. This acts like a really stable cash shield. So when the chemical business, which is naturally more cyclical, hits a rough patch, the fertilizer business is there to provide a steady stream of earnings. Their Kisan Safalta brand in particular has been doing really well and gaining market share.
And finally, the bull case points to a big, and I think crucial, change at the top. The company's moved from being a family-run business to having more professional, institutional leadership. That's a big deal. It's reportedly boosted investor confidence because it brings more discipline to operations and, importantly, more transparency to their financial reporting.
Of course, it's never a one-sided story. Every investment has risks. So now let's flip the coin and unpack the bear case. What are the key things to watch out for here? The analysis boils it down to three main risks. First, the company is definitely exposed to the wild price swings of key raw materials like sulfur and rock phosphate. Second, their fertilizer sales are really dependent on a good monsoon season. No rain, no sales. It's that simple. And third, you can never count out aggressive pricing from Chinese competitors, which is always a potential threat to their dye business.
Okay, so we've got the bull case and the bear case. Let's try to bring it all together by looking at the numbers, specifically the company's balance sheet and how they've been performing recently.
Right. So with that big spending cycle in the rearview mirror, the main financial goal through 2026 is deleveraging. That just means paying down debt. The plan is to get their debt-to-equity ratio down significantly, from 2.5 in 2024 all the way to 0.9 by 2026, as they start getting more and more out of their new capacity.
And the recent numbers seem to back up this positive story. In the third quarter of fiscal 24, their profit was up 15% compared to the year before. This prompted management to come out and say, quote, "The worst is over." They're also guiding for future core profitability, or EBITDA margins, to be in that healthy 18 to 20% range.
So what does this all mean for the outlook? Let's wrap things up by looking at the valuation. Is the stock cheap or expensive? And the technical picture from its stock chart. From a valuation standpoint, the report points out what looks like a pretty big discount. Based on earnings estimates for fiscal year 27, SPCF is trading at a price-to-earnings ratio of 14 times. Now, to put that into context, its peers are averaging around 25 times. That's a huge gap. And the research also notes that it seems like institutional investors are starting to notice and buy up shares as that gap starts to narrow.
Now, if you're someone who looks at charts, the technical analysis here is suggesting a positive signal. It looks like the stock is finally breaking out of this long trading range it's been stuck in since all the way back in 2018. According to this analysis, that kind of pattern is generally seen as a favorable sign for the long term.
So, to bring it all home, the research report we've gone through paints a picture of Shree Pushkar as a high-margin, cleverly integrated company that's now pivoting its focus to generating a lot of free cash flow. This whole thesis leads the source to give it a strong buy rating, positioning it as an attractive idea for long-term investors. So I guess the key question that leaves us with is this: can this major strategic shift truly turn a cyclical player into a consistent compounder for the long haul?